Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim, and for the two of us, it's a Happy New Year, our first interview of the year for you.
Yes, sir. Happy New Year.
2020, will the so-called phony economy in the U.S. continue, and will the equity bubble continue to grow? And when you said phony economy to me just before we went on the air, and that's why I asked that question, what do you mean by phony economy?
Well, let me explain. Yes, I mean, I think that the phony economy, the recovery, I should say, is going to continue. And yes, I think in the process, the biggest bubble in equity bubble in history is going to continue to expand until it can't and something breaks, and then, you know, ultimately the price will be paid. But when I say phony economy, I mean exactly what I said. And if you look at the data, be it the employment growth rate, and the fact is, it's contracting. And the fact is, the growth rate, the recovery coming out of the 2009 low, the employment growth rate peaked in February 2015, and it's been contracting ever since. The fact is that the GDP growth rate peaked, I can't read my notes, second quarter 2018, and has been contracting. Consumer Price Index, it peaked September 2011 and has been contracting. The ISM manufacturing numbers, contracting. ISM employment numbers, contracting. In fact, the ISM manufacturing index is at the lowest level since '09. And I don't have the complete definition of ISM, but let me digress for a minute and see if I can find it. It says it's also known as the Purchase Managers Index, and it says the Purchase Managers Index, let's see if I can find this. It is, Purchase Managers Index is in the best position to assess the ebb and flow of business conditions, and it's at the lowest level since 2009. Consumer credit is contracting. It's been contracting. It peaked coming out of the bounce out of the 2009 low. It peaked in November of 2011. Domestic automotive output peaked January of 13. The industrial production index peaked August of 2010. And it has gone below zero. It is contracting and has gone below. In other words, there's negative growth now. It's not just it's not just contracting, but it's gone below the zero line. Total vehicle sales peaked in August of 2015. The velocity of money has been contracting, but we had this little uptick, and I'm not looking at the chart, but we had this little uptick. Now it's turned down. It's contracting again. When I say the velocity of money, looking at M2. Why is it that interest rates are still so low? Why is it that another piece of data I found, rail car freight count at the lowest level in 20 years? Lowest level in 20 years. Why is that if the economy is so good? Why is it that all of this data confirms itself? It's not just that you're cherry picking one piece of data. It's all confirming the same thing. It all shows, in some cases, the data goes back to the 40s, early 40s, and it all shows that it is, in fact, the weakest economic recovery since the Great Depression, and all of the data confirms. but we're being told that it's the strongest economy in U.S. history. And it's all being camouflaged by the equity market. So that's what I mean when I say it's fake. But none of that stuff matters as long as the market continues to hold.
Tim, is that because so many people confuse the economy with the health of the equity market?
I think it's due to a number of factors. That's a question that's really hard to know the answer to. But in my mind, the market should be a function of or a byproduct of a healthy economy. But it's being spun to us. It's kind of upside down. It's being sold to us in effect that the strong stock market is the economy. And that's not the case. I think that there's a certain amount of euphoria because the market has held up as well as it has, but then I think the market has held up as well as it has because of, look, it's not taboo or conspiracy or anything like that to call manipulation. I mean, that's obvious what's going on. I mean, look at the Fed policy. Look at they tried to raise interest rates a little bit a couple of years ago and they couldn't. And so they did an about face in 2018 with that and started reversing rates. Last year, the market forced lower rates. And so, the manipulation of interest rates is in effect manipulation. The non-QE QE is in effect manipulation. The fake news and reports and telling us that the economy is something that it's not is manipulation. Yes, it's due to the manipulation, and then I think the false perception. It all feeds on itself, and it's literally an illusionary house of cards, but it's going to continue until it doesn't. And at some point, we'll get a technical setup and it'll break. But look, they've done an absolutely masterful job at keeping this thing going. I mean, who in their right mind would have ever imagined that we would be where we are? I sure did. And even think back. I can't recall the date, but remember Greenspan's irrational exuberance comment, and then we had, the bubble, and it was a bubble in 2009, with the housing bubble and commodity bubble and all that. And then even, President Trump, when he was running, in the campaign, I think it was before the election. I want to say it was in like September of, 16. He talked about the bubble and how it was the worst economic recovery. And now here we are. It's just insanity. But it continues.
We'll have more with Tim Cyclesman Wood right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, a big celebration at the White House on Wednesday about the signing of Phase 1 with the Chinese on U.S.-China trade. Do we know what's in that agreement and what it really means?
No. And where did the Phase 1 thing even come from? And how many phases are there? And that's the kind of thing I'm talking about with the news and manipulating the market. I don't recall exactly when it started. Using this China deal as a manipulation tool, and but I know It goes as far back as the fall of 2018, when the market was declining into that low back December of 18. I remember back in about October to November time frame, specifically noticing that was being used as, something, a carrot hang over the market to induce a bounce and control or however you want to say it, the decline into that low. And if you'll notice, every time we've seen any kind of little bit of weakness, it's been used as another tool. And that's the kind of thing I'm talking about. It just continues to blow my mind how this China deal has been used to entice the market. But as far as this phase one thing, I don't think anybody knows what's in it. Out of the blue, we heard, okay, there's going to be a phase one deal, and that in and of itself is kind of funny to me, because okay, so how many phases are there? Are there 3 phases or 10 phases? It's just something to keep the market looking forward. Like, we're making progress on this. It's just another tool to keep the thing going, in my opinion.
It reminds me so much, I don't know, on the Ed Sullivan show, where there would always be some clever guy who could juggle and spin plates and balance teacups on his toes and keep them all spinning at the same time. But you knew sooner or later one of them was going to come loose and the whole thing's going to crash.
Absolutely. I agree with that. That's a good analogy. It really is. I mean, they're doing everything possible to keep this thing going. And on the one hand, I understand that. I do. I mean, think about it. If you or I were in their position, would you want this to come crashing down on your watch? Well, no, probably not. But looking at it and understanding it for what it is, and looking at this data, and I'm not making these numbers up. I mean, these are hard statistics. It's been, the data's been kept for decades, and it is what it is, and it's there is. You can't dispute the underlying economic data, but we're being told something completely different, and that's not picking on this administration or picking sides, or it's just hard data, and I guess, like I said, if I was in his shoes, I wouldn't want it coming down with me at the helm. So I get that, but eventually, like you said, the ball gets dropped and it all comes crashing down. But when is that? I don't know. I don't know. I'll say this. We will see one study I've done, and I knew this. I didn't have to do the study, but I've looked at it. Every bubble you ever look at, there's always a technical setup where it finally cracks. It has to. It has to have the structure to crack from. It's always in place. It's usually subtle. It usually occurs seemingly out of nowhere, but it appears. And the other thing I go back to, you can't point to another bubble in history ever that didn't pop. They all do. They have to. Now, the one fact that someone may want to debate is that it's not a bubble, and I'm not even going to argue with you on that. If you can't see that, then fine, you'll figure it out in due time. But it without question is a bubble for anyone that has any kind of historical, technical, or even, in my opinion, common sense about the market.
J.P. Morgan last week said technically this isn't a bubble. It doesn't meet the criteria to be a bubble, that the equity market would have to be much larger before being defined as a bubble. What kind of a definition are they using, and what kind of a definition would you like to use?
Well, I'm just looking at a chart. It's a parabolic move. I mean, I wish I could show you the chart, and if you want to post it, I'll send you a chart to post, and you look at it, and you can see. I put it in the letter this last couple of weeks ago in the January letter, and shows the market just straight up. But my definition of a bubble is, to use Greenspan's words, just irrational exuberance in a parabolic move. And you can look at it from a technical perspective as far as how stretched it is from the historical norms. You can look at it from a valuation perspective. You can look at it from, the overbought readings that we saw a couple of years ago that are now, I want to say it was in October of 2018, we saw some of the most overbought readings going back to 1896. Since then, some of those technical readings, even though the market's gone higher, we've seen some divergences with those indicators, which in and of itself is suggestive of it being, an ending move eventually, or part of an ending move into some sort of a major top. But anyway, my response to that, with it not being a bubble, is I think that's just more of that fake news reassurance, just like we heard from Greenspan. He talked about irrational exuberance, then turned around when we got into the housing bubble and said, oh, there's no housing bubble. You could clearly see it's a housing bubble. I don't know how to define it, but it was clearly a housing bubble where I live, and anyone with any kind of historical perspective could see it. And it's the same with this market here. I think that's just more reassurance that everything is okay that we're hearing from from comments like that.
Where is the $60 billion a month for the quantitative easing coming from?
I don't know, and I don't know exactly where it's going. I have seen, it's been a while since I looked at that. I want to say last week or week before last, and I say this from fuzzy memory, I looked. There's a Fed site. You can go and look at it. And I want to say it was like another $300 billion that week, whichever week it was. I looked at it. So it's money's going somewhere at a rapid rate. I realize that it's short term, but it's like it's permanent. They were going to do it when they announced it. They were going to do it 2 days, and they extended it to the end of the month type thing. And now here we are. It's been going on since September the 17th. And this repo thing just keeps going on and on and on. And I realize that it's short term, and some people say that's not QE. I get it. But then, I don't know. That's a deep, dark rabbit hole. I don't understand completely, and not here to debate it. But I'll say this: the market was in trouble back in September. It was trying to set up to roll when that announcement was made, and now look at it. So it's either one hell of a coincidence, or that money is somehow making it in the market, and it is supporting the market. So I don't all the way know the answer to that, and I don't know. There's very few people, it seems like, do. That's a deep, dark, shadowy subject with this repo thing, and I don't know of anybody who really understands it. But I have looked at some data that shows that the Fed balance sheet has expanded, and from that perspective, I would argue that it is QE.
Is this much like the Bank of Japan, where they're buying ETFs, so they're not buying companies directly, but because of it, they're now the major shareholder in the top 50 companies in Japan?
I suspect there may be some truth to that. And someone sent me an article. I don't know. It was. I don't have the data in front of me, but let me see if I can grab it real quick. It was about J.P. Morgan's holdings and how it went from. Pardon me, because I don't have the exact numbers, but like 10 years ago, it went from a few billion to, I want to say it was like 2-point-something trillion as of September. And to put a trillion in perspective, I did the calculation. There's some calculators online. You can just Google it and fact check me on this. But to put a trillion in perspective, a trillion, if a dollar was a second, a trillion seconds is like 31,000 and some change. It's just shy of 32,000 years. And they went from, I can't remember the number off the top of my head, but 10 years ago it was, in a few billion to, 2-point-something trillion in holdings. And I think the point of the article was, is that direct intervention? Are they buying? I don't know. But something is fueling it. The money is definitely going somewhere, and there's definite manipulation taking place with this market.
We'll have more with Tim Cyclesman Wood right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, with all this manipulation and billions of dollars going somewhere from somebody to someone, what's going on with gold?
Gold, I still think when you look at the data that I look at with commodities, I'm pretty comfortable with the call that commodities have been in a counter trend rally. We've seen another push in gold. You know, it originally looked as if the 9-year cycle top was in place, and we saw this last push this last year as a retest, and it made a slightly higher high into that 9-year cycle top. Crude oil, gold, and the entire commodity complex, I think, has been in a counter trend move. Well, I say a counter trend. The commodities, meaning oil and industrial metals and that sort of thing, have been in a counter trend move. Yes, gold made a little bit higher high versus the high that we saw, I guess it was in 16. But I think they're trying to peak, and the data still tells me that commodities overall should go lower, which is obviously deflationary, and it's not a sign of an expanding economy. And the data is what it is, which fits, by the way, with what we're seeing from this other economic data that is evident of a weak economy. So I see weaker commodity prices. I also see overall lower interest rates. I don't think, one, the economy can support higher rates, and then in the charts and looking at the cycles, the cyclical setup and the structure, I think overall we see lower rates.
If lower interest rates really were that helpful, shouldn't Europe and Japan be booming where they have zero or negative interest rates?
There you go. I agree. And, you know, I think people kind of have it backwards. They view it because of the perception, the way it's been spun. You know, back in 2000, following the 2009 crisis, as we came out of that low, the lower interest rates fueled the market back up into new highs with everything that went on. And so people have got it in their mind that lower interest rates automatically equates to, you know, a recovering, booming economy and higher stock market and that sort of thing. But the fact is that the lower rates is reflective of, you know, it's deflationary. It's reflective of a poor economy. It's the exact opposite. And, I just, like I said, I see lower rates. And the economy proved it. You know, as rates were creeping back up when would it have been? November of 18. It was like a brick wall. And, bonds, they hit the wall, did the turn, and then the following December, if everybody remembers, that's when the Fed came out and all of a sudden they did an about face with, you know, their, dovish speak, as everybody says. You know, before that they were planning on additional hikes and the economy's good and all that, and then, the interest rates checkmated that, and then they went into the rate cutting cycle that began last year. And they say that that's over. I don't think so. I think that, we've been in this kind of, what would you call it? Kind of a period of tranquility, if you will, where commodities have bounced, interest rates have bounced as the stock market's moved higher here. But I think one thing we may see in 2020, if, commodity prices do turn back down, I think we're going to see interest rates begin to soften again. And when they do, I think that's going to put increased pressure on on equities and the economy and the Fed, consequently, and I suspect we'll see lower rates.
So many people have said with the continued problems in the Middle East, oil has no place to go but up. What's your opinion on that?
I'm not seeing it in the charts. I am not seeing it in the charts. I know that may be an unpopular view, and I understand that makes perfect sense, but I'm not seeing it in the charts. And, without getting into it here, I covered it in the letter. There's some leading economic or leading commodity data that I follow, and I show it in detail in the letter, and it's just not telling me that. I don't see it.
Mm-hmm. So, Tim, if people are interested in these charts, they can go to your website, cyclesman.com?
Absolutely. The last three letters, I have digressed a little bit from some of the traditional technical work, and looked at the underlying economy, from a technical perspective, but more fundamental data, and then putting it in the form of charts to try to understand, to try to paint this picture for people to see what I'm saying. And so that research is there. It's hard, like I said, it's hard data. I'm not buying the data at Walmart. I mean, it's hard data. Anyone that looks at the data, what I'm saying only makes sense. I mean, it speaks for itself. And then, I tie that to, the technical picture. And like I said, what we're eventually going to see is this illusion is going to continue until it can't. And then at some point, like you said, they drop the spinning plate. And when that is, I don't know. But we'll see that in the charts, and we'll see the setup. We'll see it with the cycles. We'll see it with Dow theory. We'll see it. It will tell us. But until we get some sort of a technical setup to cap it, you know what? This is just going to continue and continue and continue until it's not.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Again, that's where you can find out about the charts that Tim was talking about today. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.